So the 13Fs are out for Q1 of 2021. Of course, the 13F SEC filing shows us exactly what the big name investors have in their portfolio, so we can see what they're buying and selling from quarter to quarter. The only annoying thing though is that this info gets held for 45 days after the quarter's done before it gets released to us. That's why for January, February, March quarter, we're only just seeing the info now, even though we're halfway through May, more than halfway through May. However, nonetheless, I'd much rather have this info than not, so I guess beggars can't be choosers. So in this video, we're going to do a deep dive into Berkshire Hathaway's Q1 13F filings, so analyzing the portfolio moves of, you guessed it, Mr. Warren Buffett himself. And I'll tell you right up the top of the video, there's some very interesting stuff going on. Warren Buffett, at the moment, is definitely selling much, much more than he's buying. So anyway, let's discuss right after this. This video is brought to you by Sharesight. Sick of tracking your performance manually? Track capital gains, dividends, and currency fluctuations easily, and when it comes to tax time, have everything you need ready to go with just a click of a button. Try Sharesight for free or use the referral link in the description to get 4 months free when you sign up to an annual plan. So coming out of Q4 2020, Berkshire's stock holdings totaled $269.9 billion, up from $236 billion in Q3. However, here's the first big talking point. Berkshire's portfolio did not grow in Q1. After the most recent quarter, their portfolio was worth $270.4 billion, so up just 0.1%. So why did this happen? Well, a lot of that is down to their stake in Apple. Apple is 40% of Berkshire's portfolio, so movements in Apple's stock price will heavily influence Berkshire's portfolio value. Now, in Q3 2020, Apple went up 28%, then in Q4 it went up 13%, but in Q1 of 2021, Apple was down 5%. So that's the first reason their portfolio size hasn't continued to shoot up. But the second reason is quite simply that Berkshire did a lot of selling in Q1. And makes sense that if you reduce a lot of your positions, your portfolio is going to get smaller. So how much selling did they actually do? Well, quite a bit. They had 46 stocks in their portfolio at the end of the Q1, and during the quarter they reduced their holdings in 11 of them. Plus, they sold out of 2 stocks completely. So let's have a look. What were the big moves? Well, firstly, they sold out of Suncor Energy and Synchrony Financial, but no big deal there. Those stocks only occupied 0.09%, 0.26% of Berkshire's portfolio respectively, so not huge sells, but look at this massive long list of the companies that they reduced in. There's a lot of them. And heading up this list is Wells Fargo. They reduced 98% of Wells Fargo, which had a 0.77% impact on their portfolio. So it was actually a pretty sizable sell for Berkshire. And honestly, I don't blame Buffett for doing this, considering all the information that's come out about Wells Fargo in the past few years. It is also a convenient time to sell Wells Fargo because in 2021, Wells Fargo has just been on an absolute tear as it recovers from its crash from last year. But what this does show is a theme that has been very prevalent over the past year or so, and that is that Warren Buffett continues to want less exposure to the US financials. It seems the trend is now every time we get a 13F filing from Berkshire, we're just asking, how much stock has Buffett sold in the banks this quarter? But interestingly, Buffett did actually address this in Berkshire's most recent shareholder meeting, so I'll just quickly play a clip from that and you can hear his rationale for yourselves.
Could you please explain why you decided to exit most of your bank stocks in 2020 except for Bank of America, and what's your view on the future of the banking industry?
I like banks generally. I just didn't like the proportion we had in it compared to the possible risk if we got bad results that did not, so far we haven't gotten. So we were over 10% of Bank of America. It's a real pain in the neck to both to the bank and more to the banks than to us if we go over 10%. There's just a whole lot of, and I like the Bank of America. I mean, I like Brian Moynihan very much, and I like the banking business fine. So we took that up, but we took the overall bank position down. We didn't want to go above 10 in any of the others, and we did want to increase the B of A position, but but we overall didn't want as much in banks as we had. We like the banking business is way better than it was in the United States in 10 or 15 years ago. The banking business around the world, in various places, might worry me, but our banks are in far, far better shape than 10 or 15 years ago.
So there you go. Doesn't actually sound that bad. Berkshire just doesn't want as much exposure and would rather back, one bank as opposed to having large stakes in all of them and then just copying the paperwork of being considered something like a bank holding company. All right, moving on. Another big sell, moving on into the second big reduction. Buffett reduced 88% in Liberty Global, which is a telecommunications company. That had a 0.13% impact on the portfolio size. To be honest, I don't have much to add on that one. But if you look at this next one, they ditched half of their position in Chevron. This is a big move. As you can see, it had a 1% impact on their portfolio, which you got to remember for Berkshire is literally billions and billions of dollars. This one's really interesting to me anyway, because it was only in Q3 of 2020 that he bought Chevron for the first time. Now, obviously at the time, I thought this was a bad move and I criticized Buffett at the time because he prides himself on being a very long-term investor, and then he just goes out and buys an oil giant. But to his credit, it seems as though he is backtracking a bit, at least enough to halve his investment size. Personally, I'd love to see him keep going and ditch it completely. I hope the reduction is kind of on the back of shareholder pressure. I guess it was only a few weeks ago where Berkshire copped a fair few questions about, climate change and specifically their plans to decarbonize their own business operations. So maybe this is a bit of a move on the back of shareholder pressure. I kind of hope it is, but really I don't know. But in all honesty, if he wanted to ditch Chevron now, it wouldn't even be that hard to do it. I mean, even though he only started buying in Q3 of last year, he's still up 16% on his positions. So why not cut and run? Anyway, that's Chevron, and the only other notable sell was a 40% reduction in Merck. That had a 0.3% impact on his portfolio, but as you can see, the other positions were, 0.08% impact or 0.11 or 0.03, so not much to write about there in terms of impact to the portfolio. Although he did reduce his GM holdings by 8%, which, is pretty interesting. But overall, the sells of the quarter totaled a 3% reduction in his portfolio, so around about $8 billion of stock sales. But that seriously dwarfs the buys for the quarter. All of the buying added together increased the portfolio by just 0.9%, or about $2.5 billion. So heaps of selling, not much buying, plus Apple, which is 40% of your portfolio, goes down 5% in the quarter. And that's why you don't see a gain in their portfolio in this quarter. And to be honest, if Apple went down like 15% in a quarter, that in itself would make it very, very hard for Berkshire Hathaway's portfolio to end up in the black. But anyway, let's now turn our attention to the buys. And interestingly, they added a new position in the quarter, and that was Aon PLC. So an insurance company, nothing crazy here from Buffett. He knows what he likes. He bought about 4.1 million shares during the quarter, and currently that position is worth $943 million. So it occupies 0.35% of his portfolio, and it's the 25th largest position. Interestingly, Aon shares jumped 2% from the Buffett effect. And Buffett would be absolutely cheering on this buy because he is already up at least 10% on that position. In other news, he also added 8% to his Verizon position, making that stake worth nearly $10 billion. It's now the 6th largest position in his portfolio, occupying 3.42% of the portfolio. And lastly, he added 52% to Kroger, so big increase in that position. It's now worth $1.8 billion and occupies 0.68% of his portfolio. So overall, they are Warren Buffett's moves for Q1 of 2021. Lots of selling, not much buying, and interestingly, no real gains at all in Q1, despite the S&P rising 7% in that same time frame. Anyway, let me know what you think of Buffett's moves down in the comments section below. Please leave a like on the video if you found it useful, found it helpful. It does a lot for the YouTube algorithm, so I really appreciate it because, you know, it does take a very long time to make these videos. To be honest, for a YouTuber, there's nothing worse than putting a heap of time into a video and then releasing it, thinking it's gonna do well, and then it just flops. But anyway, YouTuber problems, am I right? Anyway, that'll do me for today, guys. Thank you very much for checking out the video. If you wanted to learn about how I go about my investing, or if you just wanted to financially support the channel, then you can check out Profitful. Links are down in the description below. But that will do me for today. Thanks very much for watching, and I'll see you guys in the next video. Thanks again to Sharesight for sponsoring this video. So recently I finally decided to stop being lazy and I imported all of my stock portfolios across into Sharesight. Finally, I should have done that a hell of a lot sooner. So with Sharesight, you sign up, you link your Sharesight account with your stockbroker, or you just add your positions manually. And then from there, Sharesight tracks everything for you. It tracks your capital gains, it tracks your dividends, it'll track your dividend reinvestment plans, it'll track gains and losses from currency fluctuations. Seriously, this is by far the most thorough portfolio tracker I have ever seen. And because they track and record everything so thoroughly, they can provide you with all of these reports. So from literally simple performance reports to complex predicted future cash flow reports if you're a dividend investor. But here's the really good thing, they also provide all of these detailed reports for tax time. So send these reports to your accountant, done. You know, plug these numbers into your tax return, done. Simple as that. It's a big, big help. And most of these features are available for free, but to be honest, to get the best experience, I would personally bite the bullet and upgrade to a paid plan. Honestly, this is one of the few stock market related subscriptions that I would actually recommend. It's very, very helpful, particularly when it comes to tax time. Anyway, if you did want to sign up, simply use the referral link in the description, or you can go to sharesight.com/new money, and Sharesight will give you a special offer of 4 months free when you sign up to an annual plan. So at least sign up for the free plan. It will make your life easier. But that's it for today, guys. Thanks very much to Sharesight for sponsoring this content, and I'll see you guys next time.